Welcome to Mission Wealth's Market Perspectives for the first quarter of 2018. My name is Kieran Osborne, the Chief Investment Officer at Mission Wealth, and I'm excited to present to you today our outlook for the economy and financial markets in 2018 and beyond. This presentation will cover three broad themes: the US and global economies, global equities, and fixed income. We believe the current US expansion may become the longest in history, as tax reform is likely to add a short-term boost to growth. Global growth is also the most synchronized we have witnessed in many years. That said, there are some structural constraints that may restrict US growth potential in the coming years. So what does this mean for stocks? Stocks rallied significantly in 2017, particularly emerging markets and international stocks. Despite this, international and emerging markets may still offer attractive upside potential. US stock valuations are expensive, but within the US, small cap and value may offer relative value opportunities moving forward. We believe the Fed may tighten more than expected this year as the economy continues to strengthen. The Fed's normalization policies and recent tax reform are both likely to decrease demand for bonds while increasing supply. At the same time, international monetary policy appears to be following in the Fed's footsteps, with a bias towards tighter monetary policy. We believe all these dynamics may put upward pressure on interest rates and downward pressure on bond prices. This chart shows that the current US expansion is now the third longest in history. We expect it will exceed the 1990s expansion to become the longest. That said, it is the shallowest recovery ever experienced, which is largely a function of structural issues. As a result, however, we do not currently see a buildup of excesses within the economy of the like that we had previously seen leading up to previous downturns. What's interesting is that since 1980, the average economic expansion has become longer, averaging around 8 years versus 3 years previously. We believe this is due to central banks becoming more effective at targeting inflation and thus providing more sustainable environments for growth. Current US economic growth is strong and above trend. We believe this will continue into 2018, with real GDP growth in excess of 3%. We estimate that tax reform is likely to add about 0.3% to GDP growth in 2018. An upcoming budget agreement and possible infrastructure spending may add more fiscal stimulus near term. It's also a very broad-based expansion. You'll see that the majority of economic inputs are at or above trend. So the economy is not anchored to any one factor, which is a positive sign for sustained growth. So how much further can this current economic expansion last? Well, based on historic data, at today's current level, we would expect another 2 to 3 years before a recession hits. Turning to the global economy, this chart depicts strength of manufacturing across countries. In short, green is good, and there is a lot of green, with particular strength in Europe. At the same time, global inflation is relatively well contained, which may help sustain global growth. Structurally, however, the US economy may be challenged in the future. This chart depicts the unemployment rate and wage growth. The current unemployment rate of 4.1% is down from 4.8% in January of 2017. We anticipate stronger growth this year in 2018, and we could reach 3.5% 4% on the unemployment rate, which would tie the lowest value since the 1950s. Structurally, we believe the economy may not be able to push the unemployment rate lower than this level. Thus, improvements in the unemployment rate may only provide an economic tailwind for one more year. As a result, the current above-trend economic growth may normalize into 2019 and beyond. "2017 was a great year for global stocks, particularly international and emerging markets. Within the US, large cap and growth stocks tended to outperform in 2017. You can see US stocks continued to extend their rally coming out of the great financial crisis of 2008. Despite historically high headline noise, political uncertainty, and geopolitical risks we have all been watching on the news, 2017 actually exhibited historically low levels of market volatility. Here are some stats for you. There were only 8 plus or minus daily moves of 1% or more in 2017. In fact, there were 4 plus 1% moves and 4 minus 1% moves. There was no daily move greater than 2%. That is the smallest number since 1965. The most commonly followed fear index, the VIX, closed below 10 4 times before 2017. In 2017, it closed below 10 48 times, and it reached 9 of its 10 all-time lows in 2017. We believe the market looked through the headline news to focus on macro fundamentals and earnings, both of which were very strong. Given the continued run-up in US stocks, the S&P is now trading more expensive relative to historic averages at 18.2 times a price-to-earnings multiple versus the historic average of around 16 times. Earnings growth has been robust, and we expect double-digit growth rates to continue into 2018. Tax reform should add a near-term tailwind, and energy sector earnings in particular should benefit, with oil now trading above $60. So given that backdrop, what does that mean for stocks, specifically US stock investments? Recall that we expect another 2 to 3 years before a recession. So the implications for stock market returns are interesting. Based on the current economic expansion, historic data supports attractive US stock market returns near term, despite the recent rally we've experienced, with an average return of 21% 2 years before the end of an expansion. But US stocks are expensive, and we caution on this. Taking a longer-term view, 99% of the time, at current valuation levels, the subsequent 10-year stock returns are single-digit or negative. In fact, 22% of the time, they have been negative. So, where is the value to be found in US stocks? While US stocks across the board are trading above long-term averages, small value stocks may offer the best relative value opportunity. Small and value stocks may benefit the most from tax reform, given the domestic bias, while a rising interest rate environment may be a positive for value stocks in particular, given the large financial weighting in that sector. Dimensional fund advisors tilts towards small and value stocks, both of which may benefit moving forward from these dynamics. DFA funds are core holdings at Mission Wealth. Taking a longer-term perspective and why we favor investments in DFA funds, the following two charts just depict the consistency of outperformance of small versus large cap stocks and value versus growth stocks. This first chart shows that over time, small stocks can tend to outperform large cap stocks over rolling 10-year periods the majority of the time. Likewise, this chart here depicts value stocks versus growth stocks, and you can clearly see that value stocks tend to outperform growth stocks over extended periods of time. Turning to international and emerging market stocks, we believe there is still upside potential despite the recent outperformance. This chart is a nice one. It shows the same chart that we showed earlier of the S&P 500 overlaid with also international stocks outside of the US. And you can see that international stocks have yet to eclipse their pre-2008 levels. So there is still some upside potential there, we believe. And at the same time, there is a lot of runway left, earnings growth in Europe and emerging markets in particular, as shown on the chart on the left-hand side here. And the chart on the right-hand side depicts global valuations. Stocks internationally and in emerging markets tend to trade in line to below historic averages, despite the recent run-up, versus US stocks, which are clearly more expensive relative to historic averages. So we believe there is some upside potential within international and emerging markets in particular moving forward. This chart highlights the Fed's most recent economic forecasts. We highlight their expectations for GDP growth and the unemployment rate, because we believe their forecasts for growth are too low and their forecasts for the unemployment rate is too high. As a result, we believe there is upward risk to rate hikes. We could see 3 to 4 rate hikes in 2018, as opposed to the 2 to 3 the market is currently pricing in. The Fed also continues to shrink its balance sheet as part of its policy normalization. This decreases the demand and increases supply of fixed income securities, primarily treasuries and mortgage-backed securities. This chart depicts the anticipated increase in supply of fixed income securities over the coming years. You can see a clear step up in 2018 and beyond as a result of the Fed's normalization policies and tax reform as well. All else equal, an increase in supply and decrease in demand for any asset naturally puts downward pressure on prices. In this instance, being fixed income, downward pressure on prices means upward pressure on interest rates. At the same time, international central banks appear to be following in the Fed's footsteps with a bias towards tighter monetary policy. In fact, 2017 was the first year since 2008 that we did not have a rate cut, only rate hikes. Because of this, interest rates internationally may begin to increase and unanchor US rates and allow them to migrate higher also. Indeed, consensus estimates point to an increase in rates globally, as shown by the top chart here. At the same time, interest rate sensitivity, as measured by duration of core fixed income, it's shown here in the chart at the bottom of the screen here, being the Barclays US Aggregate Fixed Income Index. The interest rate sensitivity is the highest level in 30 years. We are highly cognizant of this at Mission Wealth and maintain a lower duration exposure within our core fixed income than the broad market. So what are the implications of a rising interest rate environment? Well, this chart just shows the various fixed income asset classes and their historic performance through rising interest rate periods. Long duration treasuries tend to be the worst performer, whereas satellite fixed income like high yield and floating rate has historically done well. However, like many risk-on assets, we do caution on current valuations and prefer higher quality within these satellite asset classes. High quality, high yield as an example. So, in summary, given this backdrop, what actions are we taking? We continue to favor a globally diversified basket of stocks with exposures to international and emerging markets, both of which we believe have the potential to outperform US stocks moving forward. We favor satellite fixed income asset classes, but higher quality within them, such as high quality, high yield bonds, as an example. Within our core fixed income, we are highly cognizant of the interest rate expectation and the interest rate backdrop. And so we have been managing our duration exposure very closely and continue to monitor it with a lower duration exposure than the broad market. We continue to favor adding attractive diversifiers within client portfolios, such as alternatives, which may perform relatively well should we see a reversion to more normal levels of stock market volatility and a challenging fixed income environment. Overall, we believe our portfolios are well positioned for the forthcoming period, offering a globally diversified portfolio of stocks, bonds, and alternatives that may weather the potential for increases in market volatility, a rising interest rate environment, and the ever-changing geopolitical and economic landscape. As always, should you have any questions regarding anything covered in this presentation, please don't hesitate to contact your client advisor. Thank you very much.